Hello, everyone. Thank you for joining us for the on-demand segment at GTR UK. Today, our panel consisting of emerging trade fintech startups and investors will be chatting about how data and AI is being used to drive trade finance activities. I'm Ling from Reefknot Investments, a venture capital fund focusing on supply chain tech investments globally. And today I'm very privileged to be joined by three esteemed panelists. First, we have Philipp, who is the co-founder and chief data scientist at Previse. Previse is a UK-based fintech startup which uses AI to help suppliers get faster payments. And next, we have Morgan. Morgan is the CEO and co-founder of Incomlend and LC Lite. Incomlend is a Singapore headquartered startup that operates an invoice trading platform to connect exporters and importers with private funders. And we also have Kelvin. Kelvin is the co-founder and CIO of GTR Ventures. GTR Ventures focuses exclusively on early stage trade tech investments and has actively supported 10 companies to date. So once again, thank you all for joining me today. If I may, maybe I shall first kick off with the two fintechs here, since you guys are probably the closest to the topic around AI and data. So could you share with us, how are you utilizing data and AI to provide innovative trade finance products and services? Or in particular, are there sort of specific pain points that you're addressing? And what kind of additional value add are you looking to generate or demonstrate from using data and AI in your offerings? Perhaps we can start off with Philipp, if you want to have a go.
Yeah, sure. Thank you for the introduction, Ling. So at Previse, we're using data to try and make financing transactions and trade as seamless and as unnoticeable as possible for buyers and sellers and all parties involved. We start off with our flagship product, Instant Pay, which is designed and targeted at payables finance. At payables finance, you go to a large buyer and finance his suppliers. In that case, currently an important obstacle often is the process, the time it takes to check and approve the incoming invoices. And then finance providers often typically require legal commitments, irrevocable payment undertakings before they provide financing. We thought that was a bit crazy to be blocked in the financing by the requirement by a legal requirement, by a process requirement, while in theory all the data that should be required should also be available there. So what Previse is setting out is to make sure that all these suppliers can be financed instantly as soon as the invoices arrive. We do away with the need to go and have a formal legal hard and fast additional step in the buyer's processes. We replace that with the data, with the AI to score the invoices. We assess the dilution risk, and we make sure that what we finance is the transactions that actually have low enough risk that everybody's happy and nothing goes wrong. And at the same time, we also use the same approach of looking at getting a data feed directly from the buyer, listening to what's going on, what the original intention was, and then looking at the settlements of these invoices and do all the reconciliation, matching, and so forth, all fully automatic on our end. So really it is, from the buyer, it's as if they haven't done anything else.
How much, or for that matter, how little data do you actually need to drive some of this scoring and financing decisions? And especially when we're seeing kind of some macro evolving data trends that's coming out from events that are unprecedented and never happened before, like COVID and the trade war. So how do you cope with these kind of evolving trend lines and feed that into your algorithms in terms of coming up with the funding decisions?
Oh, excellent question. Yeah. The data that we need is the data that is available in the systems of the buyers. We augment the data with our own external data sources that doesn't require the buyer to deliver additional data, but it actually helps us obviously to augment and increase the ability of what we can do. And we also, it turns out that the amount of data is less of an issue, rather it is there is a large fixed cost in setting up a data feed, which we're minimizing by having pre-cooked reports and easy to use plugins, which really make this a more of a configuration question rather than a question of I don't have it. So there is a core set of data that we always ask for and always require, in addition to which is very basic. And if you don't have that data, you probably can't even process your invoice at all. Right? So that we definitely want to see and need to see. Then there is a set of data points that we are asking because they give us signals. So the whole point of AI is actually you're scoring, you're trying to get a better prediction based on signals and noisy information that you're getting. So is it not possible to have line item information? Well, yeah, that means we have more, well, it would have been a good signal. We don't have it here. Well, so the prediction becomes more noisy, but it doesn't become impossible. But maybe you will have purchase order information, which will then be a good signal. So in combination, these things will combine together. Now, so that is how much do we ask for? We ask, there's a core that we always ask for. We ask for a history of the core information because that's also very important to us. And then there is a surrounding information where we are pretty flexible in what we take, but we would like to take some of that, and we are adjusting to the specific situation, what we can and cannot get. Your second question was, what do you do if the world changes? Right? That's an excellent question because, again, when you try and do predictions or data analysis, of course, the underlying assumption is that the future will be somehow comparable to the past. And if you have reason to believe that that's not the case, then you are on shaky ground, and your predictions may fail. So yeah, when we are seeing disruptions in the world, we're seeing coronavirus crisis, but there's also other things that can disrupt. This could even be simple things that are limited to a specific transaction, a specific buyer. They change their systems, they change their processes, and that changes the nature of the data as well. In order to stay ahead of that, so let's first look at the easier ones, which are just structural breaks in the data per se. We monitor the data that we receive. We receive data on an ongoing daily basis, and we monitor what we receive, and we monitor whether there are structural breaks. Do we suddenly receive an uptick in the volume of invoices? Do we see an uptake in the amounts? Do we see, do things suddenly change in other dimensions? We're monitoring, and when we see things changing, we investigate and try and find out what's going on. And we also continuously monitor, obviously, the performance of our algorithms as well. So if there is a drop in the performance, that would also be a signal to investigate. So the first is to check whether the actual data that we receive exhibits preemptively any structural changes. Then, more or less ex post, we check whether our performance is deteriorating, so we at least stop things from going wrong any further. And the last thing, that is, if you have these global pandemic type of financial crisis events, that is actually where you have to get a bit of your own expert opinion or common sense, if you want, involved, and actually sit down and think, okay, really investigate how would this affect or how would this not affect. That allows you then to focus on specific things. So, for example, we did a deep analysis around Brexit. So we investigated which of the suppliers are likely to be potentially affected, which ones are not. And so when you have an event like that, you have to do an additional analysis based on that event, and then impose additional monitoring, or maybe even tightening the acceptance criteria on a certain subset of suppliers. In coronavirus, it's a bit less easy to do, but still you can do the same approach. Who might be affected? What should we be looking out for? Monitor that and tighten the risk. Or if it doesn't materialize, also loosen the risk, because it may be actually opportunities.
Right. Thanks a lot, Philip. Sounds like there's really quite a fair bit of fine-tuning and triangulation that's required between different data points and parameters. So maybe over to Morgan, right? How are you utilizing data and AI in Incomlend when you come up with innovative trade finance products?
So what we see in what we do in Incomlend, we do cross-border receivables financing. So the difficulty in what we do is that we will step into various jurisdictions. It could be China, Indonesia, Singapore, Hong Kong, India, and so forth, to finance receivables. Now, before financing any receivable, one of the major obstacles that we're finding is really understanding who we have in terms of customer. Because if you're dealing in one specific jurisdiction, then you can very easily get used to the different databases to tap into to get the information and really understanding your customer. So our key aspect for us in our product is really before the product is the customer journey onto the platform, and the and streamlining the entire customer onboarding journey to make sure that everything is done as seamlessly as possible. I would say this is the major aspect. So typically a customer stepping in and getting their information, having access to their information at a click of a button without them having to actually provide the information. It may seem trivial, but this is something that is really a challenge when you deal with multiple countries where you have different landscapes, different documentation that you are dealing with. And this is for us the major initial point in the journey for a customer that sets the premises for what follows afterwards in terms of receivables financing. So having access to this data and having access to it on a consistent basis is what enables us to put AI checks into it to make sure that everything is compiling with what we're looking for, is following the standards that we have on the platform.
Right. So just given the complexity that you talked to, right, around cross-border trades across multiple jurisdictions and geographies, do you face issues with, or how do you go about mitigating risks around, say, maybe data integrity, right? Because we're seeing some high-profile cases of fraud when it comes to commodity trades, which are cross-border in nature. So are there kind of features that you have within your toolkit that helps to mitigate some of these risks?
Well, this is an interesting subject, because indeed all the frauds that we've been seeing are fundamentally frauds that are linked to the shipping documentation. So these are things where you get multiple financing on a single transaction. And this is fundamentally linked to the bill of lading. This is when you get control over a bill of lading, when you have the right information on that bill of lading, this is something you can mitigate to a large extent in terms of knowing who is in the transaction or not, if the bill of lading is actually an actual document or not. And what is happening currently, I mean, probably more than data and AI, is the digitization of this entire documentation base, which will lead as a second step to a database of documents to tap into to check if they are authentic or not. Now, that being said, when you have multiple financing on a single transaction, which are all the fraud cases that we've seen, I think it revolves more around usage of a blockchain, or blockchain could be a way of solving that problem. by having checks into private blockchains and having the information linked to a given BL. A bill of lading is a single document for a given transaction. So there is a shipment, for example, of rice from Thailand going to Senegal. There will be one BL for that journey and a single identification number for that document. So the where technology can really step in, and I think it's really about blockchain in this. Maybe we're stepping away from the data and AI angle, but it leads to an AI angle as a second step, because you're getting something that is always following the same pattern in terms of information. And this is a way for different ecosystems to communicate, to collaborate, and share an information without giving information. This is the whole principle of blockchain. So linking, for example, the reference of a BL to an information, which would be financing, yes or no, a binary information, and having ecosystems communicating. So to prevent someone from going today to DBS, tomorrow to OCBC, and the day after to HSBC, for example, with different invoices for the same BL. But fundamentally, what is important to check is not the invoice, it's more the BL. And these technology solutions, such as blockchain, will enable moving forward to create ecosystems that communicate between one another on very specific information, and not releasing information in terms of rates or even who is providing the financing, which is to a certain extent irrelevant.
Right. This is interesting. So it feels like it could be almost, fusing together several technologies in which your AI
Absolutely.
will be layered upon a better set of authentified data set, right?
Correct.
Thank you. So thank you, Philip and Morgan, on this. So clearly, it sounds like you guys have come up with quite pragmatic, data-driven trade finance products and solutions for the industry. And I guess all of you, by virtue of sitting on this panel, are either believers or leaders in technology and AI adoption. However, we continue to see the persistence, right, of huge trade financing gaps globally. So evidently, there's more that could or should be done. So what I wanted to kind of find out from you guys was, where do you think we are actually at in terms of the level of adoption of trade and AI within the industry player? And as an investor in the trade tech space, Kelvin, where you look across numerous opportunities, how have you seen the scene to have evolved? Are there certain industry players which are embracing the adoption of data and AI much better than others?
Yeah, thanks, Ling. And I think Philipp and Morgan gave fascinating insights into how one looks at trade finance and supply chain lending for Previse, at least from a more domestic angle, and from Morgan's perspective, a cross-border trade angle. Both are fundamentally trade finance lending, but both are different. And I want to stress upon the fact and make one key point here, that we can have all the data in the world, but if the data input is fraudulent in itself, no amount of AI can save you from a default. I just want to make that very clear out there to the audience. Rubbish in, rubbish out, right?
Unless you use AI to detect the fraud, right?
Indeed. But then if the intent was fraudulent in nature,
okay,
then you can't get around it. And yes, AI can detect a fraudulent intent, but then the implication on that on commodities is magnified by 10x or 100x, because we see all the industry round tripping happening and all the fraud cases happening. Back to the question on adoption. In our family, we have screened, our journey has been just 3 years. We've screened about 150 non-bank platforms across the world, domestic, cross-border, blockchain enabled, so on and so forth. I want to draw a parallel between B2B lending, which is what trade finance is all about, and consumer lending. It seems to me that it's okay for consumer lenders to lose money conventionally out there, because if you look at consumer lending platforms, the successful ones, they use 1,500 data points. Everything from facial recognition to the amount of time you type on keying your telephone number, to see whether you're using that fraudulently or not, or whether you're using your grandmother's account or whatever. Now, compared, and it's okay actually today if you're a consumer lender or consumer fintech lender to have NPL of about 3.5% on your book. It's kind of okay, you know. However, the world is unfair to us trade financiers, whether it's banks or non-banks or the fintech platforms here. The moment you lose even $1 or $1 million, they kind of start to yell, right? Because why? Because it's less risky? No, in fact, if you look at the amount of data that's used to crunch and de-risk a trade finance transaction, it is not 1,500 data points. Yes, there are the black swan events and everything, but what you're looking at essentially, a BL that is hopefully not fraudulent, an invoice number, a UEN number. If you're cross-border, you can layer that with information that then gives you some parameters that then determine the risk and bankability of that transaction. And you don't need 1,500 data points. You certainly don't need to look at your eye and iris color or the speed or the way you interact with your consumer to determine whether this guy is of a worthy credit score or a lousy credit score. And yet, the trade finance gap exists. I would say, and I want to put it out there to the audience, that from my experience at least, I think the gaps are there for a reason, and there's no compelling reason to fill that gap. If it's 1.5 trillion or 5.2 trillion, there's no need for the industry to try to bridge that gap, simply because I would say maybe 30% of the gap is fake or fraudulent in nature. So there's no need to kind of like fill that gap, right? Financial inclusion and sustainable trade finance means that we use data and trade technology and alternative ways of underwriting to plug that gap. And why is adoption not there yet? Because I feel that largely, and I want to put it out there, because formerly I was also from a regulatory standpoint, I applaud the UK, and we are in GTR UK here, for its efforts to, led by the Ministry of Commerce, to have the banks automatically share data via APIs to the non-bank platforms like Previse and your other peers. Now that is not happening here. I've always been advocating for regulators to play a stronger role through a public or shared public utility model, blockchain or not, on data sharing, because they have the power actually to mitigate some of these data concerns that silos of data repositories citing GDPR or privacy concerns are hiding behind and reducing the adoption of smart and underwriting, you know. I think this will change because the world is changing, is going digital. The pandemic is accelerating that push. And I certainly see adoption increasing if, number one, the trend for digitalization will continue to accelerate. Number two, regulators, whether for the domestic or the cross-border part, must really step up in terms of playing that role, in terms of putting in place utility-like models for data sharing and for data extraction, so that the end game is that this data can be used effectively for alternative credit underwriting to then crowd in the gap for trade financing. I think I'll stop here because you know, I just wanted to put these points across pertinently.
Thanks a lot, Kelvin. It definitely makes a lot of sense. It sounds like we require a combination of efforts, right? Not just from private sector technology players, but really also from the public sector, from a regulatory point of view, to help us move towards true digitalization in a faster manner. So I would also invite, you know, Morgan and Philipp to kind of share your views, and particularly maybe your perspectives, more coming from the fintech yourself. You know, do you agree with these challenges? Are there other impediments you might have experienced in rolling out your solutions, be it from a technical or from a commercial perspective in getting, you know, buyers buy-in? So maybe Morgan?
Well, I definitely agree with what Kelvin was saying, that it's also the various institutions and governments also need to step in. It's not just about us doing this, because the data is what comes out of the machine. Indeed, is as good as what you put into it at the base. So if you can have access to genuine information from the start, then you can do actual good quality underwriting work for alternative financing. In terms of adoption, what we've seen in this post-COVID or COVID situation is we've actually seen quite a lot of things changing on our side. A lot of customers before, which were much more reluctant to digital documentation. And when I say digital documentation, I don't mean to say a scanned copy of a document. I mean the actual document being made online from the start and being shared with the buyers, for example, suppliers to buyers, up to the extent that the current scams that we've had in the industry have actually really drawn a lot of awareness around certain documents, one of which is a key document for us, which is the BL, the Bill of Lading. Digital BL solutions have really grown over the past month. And I think to the extent that in the coming 6 months or a year, probably it will be very difficult to get access to financing, even from a bank, without having the document being coming from these sources, so coming from the original source of the document. So the COVID situation has brought a lot of positive aspects, a lot of negative ones, of course, but the positive one was around digitization and the growing awareness that from the customer base, they will not always be able to be in the office and print out the documents and so forth. So from a very basic perspective, but also from the various regulatory bodies and different government bodies, there are initiatives currently that are taking place, some of which we are in Singapore, that are gravitating around this entire sphere of digitization, sharing of data, and making sure that the sharing of the data is data that is actually of good quality.
Right, thanks, Morgan. And Philipp, do you see similar changes in adoption?
Yes, well, I first want to say that I wholeheartedly agree with the pain point that Kelvin has identified. Right, data sharing must become easier. Right, it's the data is currently siloed, and in the worst case, it's siloed on a piece of paper, which is what Morgan is saying. But even if it's siloed in one system, and it's then there is a different system, and it is really hard to get that out of there and out of in the open, and that has lots of consequences for the business per se. So it's if data can't be shared easily, you have lots of information asymmetries, right? Well, Morgan will have an exporter who wants to finance a transaction, but the exporter can't convince him that the bill of lading has only been used once for financing, or is only going to be used once, right? It's even though he may be only the most honest person in the world, there is this inability to prove that you're honest, right? And that is then making it hard to finance anything, right? And so we've been working on really lots of focus on getting the data flow easier, making it less painful, and we see that this is really hard. The move to the cloud is helping. Yeah, the move to the cloud is helping a lot. We think in the large corporates. So while you used to have, well, we currently still work with large corporates who have Oracle or SAP ERP systems where we extract the data, and each flavor of SAP has been configured out of recognition at each new corporate. So there is work to just get the data out of there. If all of that, let's say 10, 20 years in the future, is on the cloud-based system, not on an on-premise system, but in the cloud, the configuration will be more standardized. It will be much easier to share that information. Interestingly and funnily, the smaller businesses are much further ahead in that respect, because they have not an on-premise accounting system. They are already on on the cloud-based systems. They're on Sage and QuickBooks or whatever, and that is cloud-based. So their data is actually easier to share, which is funny, but true. And so there is also, and there are some government, so oh yeah, governments should be doing more, and I think data protection can be actually counterproductive. I think the actual regulation is less counterproductive than the fear of the regulation. So people are afraid of sharing any data because they might reach GDPR, even though GDPR only concerns personal data, and we're looking at business-to-business data. So what the hell? What's the problem, right? But still, people say no, we can't share any data. That's the soundbite that kind of hits people. So there is a problem there, which needs to, I think the pendulum needs to swing back a little bit. Governments have tried to help as well. There's in Europe there's this PEPL standard for invoicing, and there are some they try to put some electronic standards out for interchanging of information. Adoption is mixed, let's say. It's not perfect, but yeah, at least they're trying to do the right thing. But my hope is that something that Morgan hinted would actually happen, right? So that at some point we get a critical mass of adoption and transparency that makes the people who are behind, who don't want to be transparent and adopted and standardized, actually makes that pool so toxic to finance, using a bad word, but really too difficult to finance, because there's now the concentration of all the fraudsters in there is too high, even though maybe still 80% are non-fraudulent, but there's going to be 10% who are clearly fraudulent, another 10% who are tempted. But people say, oh, we stay away from them. And that will then get the remaining 80 honest people over into the transparent place, and we actually have made progress. So I think there will be a tipping point at some point where this will actually move, and maybe the pandemic has helped getting us there. But I'm looking forward to actually getting into that world where data becomes more available and visible. So absolutely.
Right. So it definitely sounds like industry has made certain steps towards increasing adoption, be it just by pure rising awareness of the need to digitize much faster today, or the movement to cloud, but certainly more can be done, especially in terms of data sharing and transparency. Now, so given, and you mentioned also the siloed and dispersed nature of data sets, reside within different players in the ecosystem, along a very complex trade value chain as it is, well, then there's certainly a need for close collaboration between the multiple actors and parties in the system. So, and aside from like financial institutions like the banks and fintechs, we're starting to see also the big tech giants and e-commerce players like Amazon, and then also the logistics and freight forwarding companies like Flexport, starting to offer their own trade finance as an ancillary product over and above what they do on their core business side. So how do you see yourselves, either competing against and or collaborating with some of these other players in the trade finance ecosystem? What do you perceive to be your own core competencies or focus areas, vis-a-vis what kind of capabilities you think you could augment through some of these partnerships, be it in terms of building analytics, tech capabilities, or acquiring very precious sources of data access? So maybe we can start with Morgan here. You have some thoughts on this?
When we started in Incomlend, we started back in late 2015. Back then, there were very limited fintechs. What attracted us in this industry was the need there was because of the complexity of the compliance around banks and the regulatory environment, making it very difficult for companies to have access to financing. So when we started Incomlend, we saw an industry that was multi-trillion dollars big. We were tapping into a $4 to $5 trillion industry, worldwide numbers annually. And we thought this was great because there was huge potential. In the end, the difficulty and the obstacle we met was that there was a market education that was quite significant. So the market was huge, but it was difficult to have access to because we were very small in a very large ocean. So when I see all of these players currently with different models, I think it's actually, we're helping one another by doing this. I don't see this as being competition that will limit our business. I see room for cooperation. I see our platform currently cooperating with competing platforms at times, people having complementary business models, but it's all about sharing information. Like Philipp said, it's really about sharing. That makes, it's not about becoming yourself bigger, it's about everyone growing at the same time. And this is what we're seeing in the environment. So when you see someone, for example, if it were a DHL saying, well, or Grab, for example, stepping into supply chain financing, for some of its users, or DHL is more easy to understand based on the access to information it has, because fundamentally they trust the different checkpoints that they have in their system. Like Kelvin said, not as much as we have in individual lending, but this is what enables them to tap into it. But in any case, there's so much need that they will never be able to provide everything. So they'll always be doing a certain portion. And at the end, what they will be doing is educating the market, and you will always benefit from that education process because no one can have significant market shares in this industry. So the only thing is we're competitors, yes and no. We're in an ocean where you can have massive whales never really coming across one another. So we really can benefit from that cooperation between platforms, because by doing this, we're building the data systems, we're building the quality of the information, and since no one can take control over the entire market, it's we all benefit from sharing with one another.
Right, Philipp?
Yeah, there are niches or opportunities to actually help that process, right? So it's the transparency does not have to be all provided by the ultimate source of the data, right? There can be intermediaries who extract the data, prepare it, aggregate it, process it, and provide summarized information. You have credit rating agencies. They dive into the corporate's balance sheets and history and interview the management and come up with a score from AAA to single C, right? And you cannot, what we try to do is do something similar for dilution risk, right? So what's the risk that this transaction will be disputed ultimately, that everything is correct in terms of obvious errors? You can do the same thing about fraud risk scores and to look at, okay, yeah, this like stamp of approval, a validation, yeah, so some kind of, well, maybe even, and that's where it gets actually interesting also from a financing point of view, maybe even underwrite that risk. So so in dilution, we are there where we can say, okay, if we say this invoice is not going to be diluted, then we will take the risk if we are wrong, right? So we underwrite that. So not just saying it, we are putting the guarantee behind it. So you could, maybe the standardization only needs to happen at a higher level, because so going back to what I originally said, and when you asked me what data do you ask for, well, nobody wants to have a standardized transparency over 1,500 data points for consumer lending or whatever. But what you do want to have is a standardized, the relevant information so that Morgan can do and bring buyers and sellers of receivables together and get the funders to support that transaction, right? So you want to have people cooperating with different ecological niches in that space, where they contribute to the whole goal of making things flow more easily. And I think that the ecosystem is evolving, and I think it's really exciting. I don't know exactly where it's going to go to, but there is space for a lot of people who all need to work together and but they do work together. That's quite exciting.
Great. Thanks, Philip. Kelvin.
I fully agree with Morgan on his point about collaboration among platforms. Today, the banks share data if they want to syndicate a deal, right? Why are the platforms today, the non-banks, not doing that? Or why can't there be tools that with permissible permissions allow that to happen? I think it's certainly a step in the right direction for that to happen. Philip, you mentioned just now this need for not all parts of the data being necessarily from the point of source, meaning all of us going to that same digital invoice at source and sharing parts of the data. I think these are nice building blocks to go. I'm very passionate about this portion, and I think maybe Ling, that's where investors like us, into such platforms could play a stronger lead, where if I'm a portfolio, this is portfolio company A, portfolio company B, and both are also in lending, one cross-border, one domestic, we could put in place some kind of framework amongst at least portfolio companies to start kind of data sharing. That's always been my vision, and I fully feel that the role of the anchor investors in non-bank platforms such as Incomlend and Previse and others around the world have a stronger role to play in this aspect, because platforms by themselves, they don't talk to each other because they're so busy getting business, revenues, scrubbing. We as investors in platforms should play that role, I think. And better still, if I have an investment in a non-bank platform, I have an investment in a couple of them, I have an investment in a digital bank, for example, and I can invite that collaborative framework a little bit stronger. I think that's the vision of some of the mega funds being set up, around the world today. And I think this is where VCs and private equity players and even sovereign wealth funds can lead in this aspect. I think I'll just maybe stop there, because I think that's one important point of collaboration.
I can completely agree with you, Kelvin, around the need for integrating and, more importantly, synergizing across the multiple platforms and digital islands that's being formed, right? And I definitely also see much room for players to collaborate more closely within the ecosystem. While banks and financial institutions will always continue to be an important source of capital, and they do have access to certain credit data, while you have the e-commerce and logistics platforms which have very rich transactional data pools that's flowing through them, including real-time sales, inventory, operational status. And then we have the fintechs, whose core is in analytics, and risk assessment. And this would be such a powerful enabler in processing and making sense of all the volumes of data that we've spoken about in a much more meaningful way to drive better and more timely financing decisions. So we're hoping that the industry does move forward that way. And I guess this is a nice segue into our final discussion point, which is around the future, right? So going forward, how do you see the role of data and AI in trade finance evolving, right? How long do you think actually the industry will take before it starts to adopt things like AI as part of a mainstream offering? And what do you think we need to do to get us there? So maybe we can start with Philip.
I think we all agree that we already started talking about the future half an hour ago. So it is going to become more and more important. I think the need is to pressing. The trend is set. The technology advances is just going in one direction. So that will happen. If I can just add to Kelvin's point about the coordination that needs to happen, and we as a fintech, we very much welcome any form of coordination that comes by people who have outreach as a neutral, benevolent player by construction. So absolutely, that's actually a great role to play. So my view is so everything will get more digitized. I think everything is moving to the cloud, which helps getting everything more standardized, because also the vendors and software platforms become more standardized. There is going to be an ecosystem of data processing and providers that will enable then another ecosystem of financing providers and of platforms who coordinate and bring people together as well. We see ourselves more in the data providers, scorers, and aggregators, if you like. That will take. It's very hard to predict how long that will take. I think it will start in subsets in islands, and which will grow and try and which will then expand. The islands and sub ecosystems that we focus on are the ones where there is large corporates that kind of become the anchor from which things grow out. But there are also other systems that are using the same type of platform, or maybe driven by a funder, large bank. Some large banks are actually pretty advanced. I think it'll take 5 to 10 years until we are there. I think in 10 years we should have the basic standardization. There should be an established standard where, at least for invoicing information or the transaction documentation, that we will all be using pretty seamlessly. But in the next 5 years, I guess it'll be maybe the adoption will be around 50% at best.
Right. Thanks, Philip. Kelvin, how about you? How sanguine are you about the future of data and AI in trade finance?
I think 5 years, as what Philip said, is achievable. But the regulator needs to drive the right incentives. An SME or a corporate is not going to migrate to digital invoicing or digital procurement unless it benefits its workflow, etc., etc. But I think it's going to happen. I think 5 years is a good timeline. In terms of future, I noted some points here, which I gathered, over the course of our conversation. Number one, on credit underwriting, I wish that with all the data that is digitized and that is de-risked, I hope that an alternative or new alternative credit underwriting model can emerge based on the data islands that we aggregate. And I want to advocate for something based on transaction rather than on the traditional balance sheet. So a score is given not on the strength of an SME or an anchor buyer relationship, but rather the transactional flow between A and B, and then there is a prescribed score to that, and that is dynamic, and that is hopefully feeding into real life trade data islands. Number two, I think in terms of future, the more of a comment is that I think digital banks, including the neobanks in the UK, are going to change and accelerate this adoption of AI and data in trade finance. They will want new market share over and above what the incumbents are having, and they will move very, very fast. They would start B2B wallets, which I think would trigger a new wave of trade finance lending, because then we embed payment information outside of the SWIFT network, which then gives rise to a transactional score and is another parameter for credit underwriting, and which allows suppliers to get their money faster rather than waiting for the weekend and all that. The digital RMB is also a key point to take note, because we cannot deny China's role in the rise of trade within Asia and in its interaction with the UK post-Brexit or not. that in itself, manifested in B2B wallets, brought about by the Tencents and the JDs of this world, and the whole rise of B2B marketplaces will then have a definitive impact on how trade finance is being shaped across those lines. Just two other points before I bore the audience. I want to advocate for the use of this data to also securitize debt tranches on tenors that cannot be met either on the first 20% required to, because banks and non-banks traditionally do 80%, and the 20% can be tranched out in a securitized manner using data. And finally, trade financing backed by data. We've always talked about beyond and physical goods. We never talked about services. I think that is an interesting nut to crack in itself, particularly around the recurrency of services related to telco, or internet and all these ancillary services, who are themselves also suffering from late payment terms. To all the lawyers out there, I'm sure you all know the pain points, and you wish your invoice can be factored to some extent, right? But there's no service provider out there that can factor or discount your invoice. I shall leave the audience with these few pointers, and thanks very much.
Thank you, Kelvin. And Morgan, are you seeing, more untapped opportunities where data and AI could be more widely applied?
Well, I definitely see a growing cooperation between ecosystems and ecosystems being built up. So from that perspective, there are definitely a lot of opportunities. As different players integrate within these ecosystems and bring in their own recipes to the way of generating quality information and how to deal with the information, I think everything put together, we will see something that will be much, much powerful as a solution overall. I think the current crisis currently is actually a turning point from the traditional financing model to something that is more technology driven. So far, we've talked about fintechs being finance and technology. I think we're at a stage when technology is really going to make trade finance an investable asset class based on the quality of the underlying assets and information. And the quality of the information is all about cooperation between systems, interesting ways of dealing with the information, and also having these ecosystems being built. And like Kelvin was saying, is not just about the company itself, it's about the VCs, it's about the governments putting the pieces together. And this can go, I think it can go very fast. If we look at mainland China, maybe 5 years ago when there was a lot of paper money going around, if we look at now the society that is really literally without paper money, everything is digital, it means that in very little time, the society can change. And the speed of adoption of these technologies can be exponential. It can go faster than we think.
Thank you, Morgan. So with that, I'm afraid that's about all the time we've had for today's panel discussion. Right? Thank you all very much for joining us today. Especially thank you to Kelvin, Philipp, and Morgan for spending time with us and sharing your very generous and frank and honest insights. I hope you all enjoy the rest of the GTR UK event.